All you need to understand the market today in a nutshell. This is Market Today by N3WS.
Welcome back, everyone, for another deep dive. It's Friday, September 27th. You know what that means. Time to unpack today's most interesting finance stories. And, well, we've got quite a bit on our plate today. Legal battles, corporate shakeups, and maybe even a stock market roller coaster or two.
Should I buckle up?
Oh, I like that. But remember, this is a deep dive. No seatbelts necessary down here in the world of high finance. But speaking of high finance, let's jump right into our first story. OpenAI. Now, this isn't about their latest AI model, though. It's about the people behind the scenes. We're seeing some high-profile departures. Big names like CTO Mira Murati leaving the company. And naturally, well, it's got everyone talking.
Yeah, and the timing is definitely interesting, especially with OpenAI's recent funding round.
Huge investments, right?
Massive. But there's a catch. Investors have this clause. It lets them back out if OpenAI doesn't restructure within 2 years. That's a lot of pressure, even for a company leading the way in AI innovation.
Trying to balance groundbreaking AI research with the demands of, well, venture capitalists is no walk in the park, is it?
No, not at all. It's a real tightrope walk. OpenAI is kind of caught between, staying true to their mission, that idea of developing AI for everyone's benefit, and the possibility of huge profits, right, if they shifted to a more commercially driven model.
And where does that leave CEO Sam Altman in all of this? He's been busy, hasn't he? Reassuring staff, emphasizing OpenAI's bright future, that sort of thing. But actions often speak louder than words.
Absolutely. Altman's reassurances are probably calming some nerves right now. But the question is, will OpenAI's potential new direction, will it compromise their initial vision? Is this just growing pains or a sign of something, fundamental changing? The next 2 years will tell.
It's definitely a story we'll be keeping a close eye on. Now, switching gears completely, our next deep dive. It feels like something ripped straight from a financial thriller. JPMorgan Chase is taking on the U.S. government.
This isn't just a regulatory spat. This could be a full-blown legal showdown, one of the world's biggest banks versus the very agencies tasked with overseeing them.
The Consumer Financial Protection Bureau, the CFPB, they're considering some serious penalties against JPMorgan Chase, right?
Yeah.
For their role in all those Zelle scams we've been hearing about. But JPMorgan isn't backing down. They're threatening to sue the government.
It's a bold move, for sure, and it speaks to this larger trend. Banks aren't just accepting regulations anymore. They're pushing back hard. Remember, after 2008, the financial crisis, banks were on the defensive. It seems like the tables have turned.
So what's the deal with Zelle and JPMorgan Chase?
Well, Zelle's become incredibly popular, right? It's this digital payment platform. But that ease of use, well, it's made it a target for scammers. And JPMorgan Chase, they've faced criticism for not doing enough to protect consumers from these scams.
And that's where the CFPB steps in.
Right. But JPMorgan Chase claims they're being unfairly targeted, that the CFPB is overreaching. They've even rolled out new features in their Chase app, like disclosures about the risks of scams to show they're serious about consumer protection. It's like they're saying, hey, we're taking action here.
A classic case of who watches the watchman. But it also brings up a good point. Who has the power here? Are regulators overreaching? Are banks becoming too big? It's complicated. No easy answers.
And it's not isolated. This JPMorgan Chase case, it's part of a larger pattern. Like, look at how banks reacted to the Basel Endgame proposal, that big regulatory overhaul trying to make the financial system safer, or their fight against the CFPB trying to limit credit card late fees. Banks are flexing their muscles, challenging regulations, pushing back against what they see as government overreach.
It's a real power struggle, isn't it? Like we're in some kind of financial coliseum. In one corner, you've got the regulators trying to keep Wall Street in check, and in the other, well, the banks are saying too much regulation, it's going to stifle innovation. That it hurts consumers in the end.
Right, and the stakes are high. I mean, a healthy economy needs a healthy financial system. Too much regulation, sure, it can stifle growth, but too little and you're risking instability, even a crisis. Finding the right balance is tricky.
Speaking of challenges, let's talk about Supermicro. They've been in the news quite a bit lately.
Yeah, not exactly for the right reasons, though.
So for those not familiar, they're a big player in tech, supply components for data centers, high-performance computing, that kind of thing.
Right, but they've had, well, a string of bad news recently. Their stock's taken a hit, concerns about their profitability. Then there was that short-selling report accusing them of accounting irregularities.
Oof, that's never good.
And if that wasn't enough, there are rumors of a potential Department of Justice investigation.
It's a lot for any investor to stomach. But here's the thing. In the middle of all this, Supermicrocomputer announces a 10-for-1 stock split. Now, usually companies do that when their stock is, flying high, makes it more affordable for more investors. But with Supermicrocomputer, well, their stock's been heading in the opposite direction.
It's definitely unusual. Some analysts see it as a sign of confidence, like they're telling the market, hey, our stock price doesn't reflect our true value, but others, they see it as a distraction tactic.
Like they're yelling, look over here, shiny stock split, while hoping no one notices the DOJ investigation potentially brewing.
Exactly. But all jokes aside, it's risky. If they can't deal with these accounting and profitability concerns, this stock split could backfire big time.
It's a high-stakes gamble, and it underscores a crucial point for investors understanding the difference between a company's fundamentals and how the market perceives them. A stock's movement doesn't always tell the whole story.
Exactly. Investing isn't about following the herd. You need to do your research, be diligent, and, a little skepticism never hurts.
Words to live by. Speaking of skepticism, Nvidia, talk about a company generating excitement. Their stock price is on a tear, thanks to the demand for AI chips.
For good reason. Nvidia is at the forefront of the AI revolution. Their QPUs, their graphics processing units, they're the brains behind everything from self-driving cars to medical breakthroughs. And let's not forget those multimodal AI models we discussed, the ones that understand text, images, videos.
It's no wonder their stock is soaring. One analyst even predicted it could hit $200 in the next 2 years. Even for a company used to exceeding expectations, that's a leap.
It's a bold prediction, yeah. It shows the incredible potential of AI. And Nvidia's in a prime position. They have the technology, the know-how, the market dominance, everything to keep this momentum going.
But the stock market, let's be real, it's unpredictable. It can be driven by both rational things like earnings and totally irrational things, fear, greed, and sometimes it gets ahead of itself, especially in hot sectors like AI.
Right. Nvidia might be a fantastic company, but that doesn't mean their stock will go up forever. There's always a chance of a correction, a sudden drop that catches investors off guard.
It's a real balancing act, isn't it? Trying to separate the hype from reality, especially in a field as complex as AI.
Absolutely. That's why investors need to stay level-headed. Weigh the potential rewards against the risks. Don't let your emotions make decisions for you.
Great advice. Now, before we get to our last story, a quick detour to Costco. They just announced their fourth quarter results, kind of a mixed bag. Beat earnings expectations, always good. But revenue fell a bit short. Even retail giants aren't immune to the economic climate.
It's a good reminder, right? We're not out of the woods yet. Inflation is still looming. Consumer confidence isn't great.
Especially with those interest rate hikes we discussed. It takes a while for those to really be felt. But Costco, they seem to be weathering the storm pretty well.
They are. And their business model is a big part of that. They focus on value bulk buying, no-frills shopping. They've got this loyal customer base because people trust them to deliver quality products at good prices.
And in uncertain times, people want reliability. Like that saying, better to be in a battleship than a speedboat during a storm.
Exactly. Costco's that battleship. They may not make the biggest splash, but they've got a knack for navigating choppy economic waters. It's that long game, that consistency, and it seems to be resonating.
It reminds you, sometimes the less flashy companies, the ones not always in the headlines, they're the ones quietly delivering for investors. They're not reinventing the wheel, just doing what they do well day after day.
Which is often the key, isn't it, in business and investing? It's easy to get swept up in trends, trying to time everything perfectly. But sometimes you find a solid company, strong fundamentals, and you stick with it.
Like the tortoise and the hare. But the tortoise is running a multi-billion-dollar company now.
Exactly. But speaking of long-term thinking and potential game changers, maybe we circle back to where we began OpenAI, a company wrestling with some big questions about AI's future. Their choices could have a huge ripple effect.
No doubt. We discussed their potential shift, right, toward a more profit-driven model, the pressure from investors. But let's not forget the bigger picture. This is a company at the edge of a tech revolution. That comes with some serious responsibility.
It's like they've got the keys to this incredibly powerful car, and they're still figuring out the rules of the road. Do they gun it, push the limits even if it means taking risks? Or do they play it safe, prioritizing control over breakneck speed?
Not an easy balance to find. I mean, they have the potential to create AI that solves the world's problems. But there's also the risk of creating something we don't fully grasp, something with unintended consequences.
It's a dilemma straight out of science fiction, and now it's playing out in the real world. And here's the thing. This isn't just on OpenAI to decide. It's a conversation we all need to have. as a society.
Because ultimately, AI is a tool, and any tool can be used for good or bad, depending on whose hands it's in.
That's it, exactly. We need to ask the tough questions. What do we want AI's role to be in our lives? How do we make sure it's developed ethically, responsibly? How do we even prepare for a future where AI isn't sci-fi anymore, but a force shaping our world?
Questions without easy answers, but we have to ask them. And that's what I find so interesting about these deep dives. It's not just numbers and reports, it's the future of tech, of humanity, finding that balance between pushing boundaries and being responsible.
Well said. And sometimes asking those questions, that's even more important than having the answers.
Couldn't agree more. Well, that about wraps it up for another deep dive. We've covered a lot of ground. Corporate drama, legal showdowns, the ethics of AI, even the importance of thinking long-term in a world obsessed with the short term.
It's always a pleasure digging into these stories with you.
And to our listeners, thanks for joining us on this journey. Remember, knowledge is power, especially in today's world. So stay curious, stay informed, and we'll catch you on our next deep dive.